Hello, everyone, and hello, Shakti. Today, we're gonna discuss several things. Firstly, there are some interesting stories about great investment failures, and also we will talk about dividend portfolios and different strategy that you might consider. And we will bring some famous figures into our equation. So, Shakti, the other day you told me heartbreaking story about your investment in Google.
Everybody who does investing once in their journey will face this once or twice or many times, depending on the person, right? So I had an issue with Google wherein I bought it when it was at $90, and I put all my money in Google. I waited for the market to respond because I knew that once Google starts announcing its quarterly results, the market will realize that Google is still the leader in search. But I couldn't hold on to Google for more than a week or so because even I had the same doubts that the market had. I went in Google, I went out when it was around 100, and again I went in around 104, and I came out again after a couple of weeks. And it was a tough journey for me for a couple of months or so. But I finally gave up and uh, pulled all my money from Google and put it in the overall market, right? So if I had stuck to Google at that time, my money would have easily doubled or more than doubled. And I would have had a much bigger portfolio now than I have with the overall market. What is your opinion?
Well, my opinion, I have Google in my portfolio and this is a top performer at this moment. But I brought this story because just recently I read about one of the smartest people of all the time, Isaac Newton. He was apparently an investor. Just a quick story. In 1711, Newton acquired shares in the South Sea Company. And that was a great investment initially, right? But it was just something was going on that made Isaac Newton to think that, this is the time to sell shares. And 1720, he has sold all the shares for a great profit. He was at that time 77 years old. He has seen the life, right?
He is probably the smartest person around at that time.
Absolutely. The stocks is continue to climb up and up and up. 77 years old. And he just didn't resist and he bought his shares for double the price. He also bought extra. So overall that was about 20,000 pounds. And if I convert it to today's currency, that's 3 million. Lost everything. Imagine.
Hey, that is the same situation we are in with the current overall US market, right? So everybody says the market is overvalued. Now, the market was overvalued 2 years back also. If somebody listened to the daily news and sold all their shares at that time, they would have missed the rally that had occurred in the last 2 years because of AI boom, right? Now we
Yeah.
have 70% from that 2 years ago.
Yeah.
Now, when that person who had sold might have the same feeling that Newton had and might jump back into the market now. And you don't know, right? The market could again double or it could also fall by 50%. Nobody knows that. And it's the
Absolutely.
same thought process or issue that everybody has. And that's why we say time in the market is better than timing the market. So just stay in the market. Whatever happens, just ride the wave. If it goes up, it's fine. If it goes down, you add more.
Yeah. Newton said after that experience, I can calculate the motion of heavenly bodies, but not the madness of people.
I have the same problem. And that's why we do the fair value estimation for every stock. Because currently, when I do the fair value estimation for, let's say, Palantir or Tesla or whatever, it says for the next 5 years, this company has to grow more than 50% or 75% to justify today's market price. So somebody out there believes that this company is going to grow at that level or that speed, and they're pumping money into these stocks, which make it extremely overvalued. Now it's up to us. We have to decide whether to stick to those or sell them, get out. Nobody knows.
Well, do you have more stories?
I have this heartbreaking story for from Rolls-Royce. So Rolls-Royce is not a US stock, and it is not even a car company, right? People assume that Rolls-Royce stock means it is you're buying into the car company. That is different now. So what Rolls-Royce does is making parts for engines, but the brand everybody knows. Everybody knows what Rolls-Royce is. The stock was trading at $1.5 in 2021 or so, and I put in I think $20,000 into that. I bought 14,000 shares. Now, one of my friends knew that, and he said it's one of the best buys I ever made. The analysis and everything, but the company was actually struggling at the time, so nobody knew whether this will go up or down. And from 1.54, it started slowly going down, and I panicked as usual, right? So I actually sold out of it, and it did go back to almost point 0.8 cents, which is almost a 50% drop. I was happy that I made the right call by selling everything, right? Then I did not look at the stock for a long time. Like in 1 year back, I just opened to see where it is, and I was shocked, right? Now, if I open, I see it at 15 plus dollars, which means the stock has moved from 1.5 to 15. That's 10x. All I had to do was just hold on to that, and it would be such a huge part of my portfolio now, right? But I couldn't do
Yeah.
that. Whoever did that, kudos to them. They made a lot of money. Well, my analysis was great, but again, I couldn't hold on to it. And that's one reason currently I have most of my holdings in the overall market. I feel a bit
Yeah.
secure and safe. It's beyond logic.
So, do you think that it's a better strategy to invest in dividend stocks? And how would you estimate your return then?
It's not a better strategy, but it is one of the strategies, right? So for someone like me who is worried about how the market is going to react, I may want to pick companies which are quality companies by definition. And also, they pay a growing dividend with an yield which is not too low, let's say 2.5% to 3% or more. Right. If I hold such companies and if they keep growing their dividends based on historical data, I don't know what's going to happen in the future. But based on historical data, I can predict the probability of these companies not growing their dividends in the future. And I can create a collection of such high quality companies and just collect the dividends every quarter or every month, depending on when they are paying it out. And that's what I have done for a small portion of my portfolio, where I've collected quality companies which have paid growing dividends over the last decade or so. Now, among these, I have like 30 companies now, right? But among these, some could default. For example, Triple M. Triple M was a great dividend paying company, which also kept growing its dividends. But they had an issue with one of their products or business lines, and that led to legal issues, and the downfall started for the company, right? So they cut their dividends, which was heartbreaking for all the dividend investors. Dividend investors do not like companies that cut
Yeah.
dividends. Same with Intel, right? Intel was also considered a good dividend company. So these things can happen. That's why you need to have a diversified portfolio. And when you have more holdings, more quality companies with you, the probability of all of them going down is much lower, irrespective of the market conditions. It doesn't matter if the stock goes up or goes down, as long as you believe that the company and the brand is doing well. When the market recovers, you'll be fine. And when the market is down, you still get your dividends, and you can reinvest your dividends if you don't need it for expenses. And when you reinvest dividends when the market is down, you are getting the stock for a cheaper price, which is even better.
Yeah.
If you have a long term investing horizon, reinvesting those dividends can create a snowball. And at one point in life, you could be able to just retire off the dividends itself. And that really works well for young investors if they start in their 20s, which is much better. So when they retire, they have a dividend portfolio which can give them a lot of dividends. But this is the positives. Well, what is the negative, right? These companies will not grow as fast as a startup, a tech company which is coming up with new products, and so on and so forth, right? Nobody predicted that Tesla would grow as much as it did, and Nvidia, and there are several other names which did the same. Meta and Google recently started paying dividends, but for majority of their existence, they never paid a dividend. So if you just focus on dividend stocks, you're missing out on the growth of these
Yeah.
tech giants and so on and so forth. One thing I've learned is if you are young, it's better to mix your portfolio with some of these names. So over the long run, you don't miss out on the growth also. But
Yeah.
if you are in your retirement phase, it depends on the person. If they still want to enjoy the growth, they can, or they just rely on the dividend stocks. I think dividends make more sense if you're in your retirement phase. Um, it's there is no one answer, but there is pro and con. You have to choose.
Yeah, absolutely. Please share, like, and subscribe because it will help us a lot. We will appreciate.
Okay, so
Great.
this is my dividend portfolio within StocksDojo. I can create my own portfolio. I can create multiple portfolios, which could be real or imaginary. This one is actually real, and recently I added $1,000 in 30 odd companies. If you see, this is the result from yesterday. Most of the companies were red, but over the past month or so, this account has been doing okay. I'm just showing you what happened since yesterday because I built this yesterday in StocksDojo. And
Yeah.
if you see the allocation percentage, it's less around 4% or lower than that. So I'm keeping it diversified across the board.
Yeah.
And one thing you can do with this is check what is the current dividend yield, which is 3.28 when you combine all of these stocks. And if you want to also look for future projections, we can go back to edit. These are all my virtual portfolios. If I go to the dividend mix that I just showed, we can analyze the portfolio. So there are 30 tickers. Our process will analyze all the tickers and come up with a consolidated report, which will give you details of what happened for these set of stocks from when one of these companies like VC was IPO'd, right? So VC came into existence in 2018, and that is limiting the start date of the portfolio. If I remove VC, I can see even further back, right? But for this particular portfolio, I only have information from 2018 since VC is blocking it. And if I had invested 31,000 that I have today, it would have given me a 84% return, and the CAGR is 8%. So as I said earlier, if you had put the same money in the market, you would have received much more in returns, as it contains all the growth companies. And since these companies are not technically growth companies, the returns have been average, which is only 8%, right? But why would I invest in these companies? It's because of the future dividend projections that I expect. In our app, we have this tool. It's called the DRIP calculator, dividend reinvestment calculator. I have set the dividends to be reinvested. And if I project for the next 10 years with a growth percentage of 6% for both the dividends and also the stock price, I would end up with 77,000 in the next 10 years. The total dividends that I receive now is around 1,000, but it will be 16,000. The yearly cash dividends that I receive would be around 2,300. Technically, my dividends have more than doubled over this time frame if they maintain a 6% growth. And if you look at some ETFs like SCHT, they have done much better than 6%. So the 6% is a conservative number. And if I expand it to 20 years, then immediately you can see that my dividends have grown 5x from $1,000. And if I do a 30-year time frame, if you start investing around 30, then when you retire in 60, what do you get? So this $1,000, without adding any additional dollars, has grown to 13,600, and that's the goal, right? This is the snowball effect that we are seeing here. 1,000 became 2,000 in 10 years. 2,000 became 5,000 in 20 years. Exploded to almost 14,000 30 years, and this is without adding additional money. But we are just reinvesting the dividends. But if I contribute more, let's say every month I'm adding $1,000, this will change the equation completely. And if you see, you will end up with $65,000 in dividends, which is almost $5,000+ every month. So starting small with just 30,000, and by adding $1,000 every month, I can increase my portfolio value to more than 2 million and also receive dividends of 65,000. And that's the beauty of dividend investing. And I guess now you get the picture.
This is so cool, such a great tool, and I think it's quite motivational as well because you often have a choice: or should I save, should I invest, or should I just hang out and just have fun? And well, by seeing actual impact in X years, it would motivate me to stick to my plan and maybe don't go crazy and save all my money, but at least some portion dedicate to that, so eventually I can enjoy and don't worry about anything. Wow, love it. Thank you, Shakti. It was a great discussion as usual, and see you very soon. But bye for now.